Welcome back to the IIF Future of Insurance webinar. It is my pleasure to welcome our last panel for today, which will explore sustainable investing in insurance underwriting. This panel will be moderated by my colleague, Jeremy McDaniels, who is a Senior Policy Advisor at the IIF. I'm pleased to welcome Jeremy and his panelists, Hugh Francis, Director, External Reporting Developments at Aviva, Emanuel Rocher, who's the Deputy Director for International Affairs at the ACPR, the French Supervisory Authority, and Martin Wayman, the Head of Sustainability, Emerging and Political Risk Management at Swiss Re. Let me now turn it over to Jeremy.
Thanks very much, Francis, and thanks everyone for joining this discussion today. Very happy to be joining you for this last session of this Future of Insurance event. We have quite a wide range of issues that we can discuss on the sustainability agenda and its links to the COVID-19 pandemic, and also what this means for the insurance sector in terms of its underwriting and investment activities. So without further ado, I think we'll just jump right in with an opening question for all three panelists, starting with you, Hugh, Francis. First of all, to what extent has the COVID-19 pandemic influence the overall sustainability agenda? And from an Aviva perspective, how has this affected your strategy on climate and sustainability issues?
Hi, Jeremy, and morning to, or afternoon, morning, depending where you are, to everyone. I think we've got to look at this in the context over the last couple of years. There's really been an increasing investor awareness and political traction behind the whole issue of sustainability, which has to be welcome. We've seen a lot of action on that in the European context and also in the UK, which has got to be commended. And I think, as Jonathan said, it's always been recognised that insurers play a key role in this, and that's hence we're seeing the increasing central bank and regulatory focus. So in short term, actually, I don't think there's really any sense of change in that. If anything, I think that has been increased and reinforced by actually the problems that we've seen on COVID-19, which reinforces that was an expected but unknown when it was going to occur risk. But clearly we're in pandemic where when we go to the climate and the risks, we have a known risk that is going to happen if we don't do anything else. I mean, for us as Aviva, we've been engaging on this for many years and are very active in this area. We did a roadmap in 2015, and it was only in last September when Morris, our CEO, presented it to the UN. And as part of that, one of the things we launched was what we called the Marshall Plan to save the planet. I'll come back later on that, about how governments and the private sector can work together on this. I think one of the things that the tragedy of COVID-19 has really illustrated is that actually we're now in the situation that we've had both a health and an economic crisis. And that actually does present us now at the stage of a real opportunity to focus how we emerge out of this. And that's got to be welcome that we're now very much all on the same page about looking for a green recovery. So I think, therefore, there remains a very strong commitment to ESG and sustainable finance. And there's acknowledgement we need that to be a green and sustainable one. And I think investors and the consumer are now probably seeing those risks, and we need to leverage that opportunity that we now have. I mean, it's really important that we both walk the talk, both walk the walk, and we also talk the talk on this area.
Thank you, Hugh. Over to you, Martin. How do you see the sustainability agenda moving forward? Do you see things have been slowing down or sidetracked, or do you see things are going full steam ahead?
Yeah, thank you very much for the IIF to organize this important event on the future of insurance, and Jeremy for hosting this session. So I very much agree with what you just said on this is a unique opportunity for the insurance industry to step up. But I think what is very important, the insurance industry can't move the climate and sustainability agenda alone forward. So we are very much looking out for partnerships. Let me quickly give some thoughts to COVID-19 and the consequences. So on the pandemic, this is not a black swan. There were, in the Zero Forum as an example, already in 2007, a publication on infectious diseases and influenza pandemics. We had in our own emerging risk report, the SONA report, raised those topics in 2013, 15, and 17. But still, the extent to which the lockdown happened, I think that's a bit a surprising topic and will put, when we link it to sustainability, the topics which were normally mainly on environmental topics put more the social in front and center. Second point I want to make is the crisis is definitely not over. So we have seen the major impacts on the economic crisis, the health crisis in some country definitely very much going on, in others at least for the moment contained, but this will also lead to a thinking, how can we rebuild what you refer to the green recovery, and I would add it's not only green but a broader sustainable and resilient recovery, which leads me to the next point, the concept of resilience in this context, which I see very much linked to the insurance and sustainability agenda. Unless we have a risk front and center in our face, humanity often doesn't act. And I would say the COVID-19 crisis is could be a compressed form of what we could see on climate change. So time compressed, but climate change definitely being much longer will be a topic. And therefore, I would say the resilience discussion and the importance of risk awareness in this context has risen quite dramatically. But I think we need to make sure that also this is translated into other categories. And therefore, I think there are a lot of learnings from this crisis as well, but also climate change remains as important as it was before. And then the last point, I think there are two thinkings. There could be more nationalist, populist reactions to such a crisis, which would put a bit the spiral to the negative, probably to the global economy and also supply chains. But there's also another way where you can see there's much more solidarity and increased opportunities for many people. And I think here the insurance industry, as I said initially, can partner up with many companies. And as we have been very much promoting sustainability, not only since the last 2-3 years, but really over the last 2 decades at Swiss Re, and have made important commitments last September at the UN Climate Action Summit to move to net zero by 2015 on both the underwriting and the asset portfolios, as well accelerating that for the operational part already until 2030. So I think, to sum up, the COVID-19 definitely will shift some focus from environment to more social and also some governance topics when we talk about ESG, but by no means it stops basically this discussion. I think there's now a lot of momentum, and I think both governments and the private sector need to work together to make this happen, and we have a chance to really make this happen.
Thanks very much, Martin. And I think that the question of an accelerated view of the impacts of climate change arising from this crisis is definitely top of mind for the sustainable investment community, and that's a topic that we will turn to shortly. Now, turning to you, Emanuel, from a policy and regulatory perspective, how has the COVID-19 pandemic affected your views and strategies and priorities on sustainability and climate risks?
Hi, Jeremy, and good morning to everyone. I just wanted to thank first the IF for hosting the event. To answer your question, I just think we'll start with a short paradox. I mean, despite the challenges posed by the COVID-19 crisis to our organizations, and despite the different emergencies we have to cope with, actually, we did not postpone the different pieces of our ongoing work on climate and sustainability issues, whereas we had to do so for many other topics. On the contrary, we got to deepen our analysis. For instance, before the crisis, we were already working on protection gap issues from a climate and sustainability perspective at the European level. The COVID-19 crisis led to an acceleration of this work and led to the inclusion of the pandemic as a factor likely to cause increased inequalities and loopholes in the insurance coverage of certain risks and also in the coverage of certain countries. I think in particular about countries which are deprived from public reinsurance system, for instance. Another point I wanted to mention is that if we think about the analysis made by certain scientists on the possible link between pandemics and environmental developments, showing that, for instance, the melting of the permafrost could release new viruses, then yes, I think we could understand and consider that the COVID-19 crisis has actually contributed to highlight the importance of climate and sustainability issues, which remain naturally on top of the agenda of the supervisors.
Thanks very much, Emanuel, and definitely a lot of really important and interesting work underway on the regulatory front that we will return to later on in the panel. Now, Martin, I'd like to turn to you to discuss specifically some views on market dynamics and maybe in the context of the low carbon transition and sustainable development more broadly, ideally in this green recovery mode once the immediate health crisis of the pandemic has abated. What are your views on the sustainability opportunities for insurance underwriting going forward in this green recovery stage, and what are some of the risks that you see potentially emerging?
Okay, thanks, Jeremy. I think Swiss Re has been on this sustainability journey for, as I mentioned, over 2 decades now. And climate change, both from a physical risk perspective as well as from a transition risk perspective, are centerpieces of this sustainability strategy that we renewed last year with 3 key areas. So one is mitigating climate risk and the energy transition, so very much to the point that you just made. The second that we said last year is really building societal resilience. That's something that we started already at Swiss Re earlier, but now definitely becomes more prominent and important as well. And then driving affordable insurance with digital solutions as well. So the insurance industry and Swiss Re specifically as well can be seen as a catalyst for sustainability related action far beyond our industries. Insurance is needed in so many ways to basically make not only the economy but society go round, basically. And I want to describe briefly this dual role as a risk taker and an investor as we act as a catalyst for action there on climate change. So we are leading the way by financing climate resilient measures and the low carbon investments, and through that also our risk transfer products acting as a change agents in key sectors of our economy. Let me illustrate it with 2 examples. On climate side, we on the one hand support infrastructure projects as well as just communities to adapt to unavoidable climate change by classical NatCat covers, but also by parametric covers. And on the other side, we promote or support the insurance of technologies key to the transition to a low carbon economy. As an example, renewable energy is definitely one where prices have been falling dramatically and are since a couple of years competitive with fossil fuels prices to install new power plants. And so that's something which we want to further use and support. As a risk taker and underwriter, we then provide reinsurance solutions. And I think there we help communities and businesses get back on their feet very quickly after a disaster hit. Through better design of products combined with integration of risk prevention and other add-on services, we're contributing to narrowing the protection gap in these areas. We also offer that support in transition to more sustainable low carbon energy systems, but also are exploring topics like carbon removal, which are topics which we just will highlight in a report which will be launched tomorrow, which is called Sonar Report. As an investor, we are one of the first in the industry that switched completely to ESG benchmarks and had done that in 2017, which resulted in slightly better returns with less volatility in the portfolio, which was really the conclusion. It just makes economic sense. And in 2019, we introduced further measures there and also reduced our exposure to coal as an example. So on both sides, we apply also, besides all the opportunities that we look at, we apply a sustainability risk framework, which has been built up over quite a number of years to focus on those risks, be it on the environment or the societal/human rights issues or specific to industries, to ensure that we take on those risks worth taking and avoid those risks which lead to undue risks which we don't feel comfortable taking. In essence, we believe a sustainable business is good business, but sometimes you need to take a long-term perspective. And the insurance industry here is uniquely placed to take this long-term perspective in this.
Thanks very much, Martin. Really great insights there. Maybe turning to you, Hugh. Clearly, Aviva is recognized as a leader on responsible investment. I mean, what has the experience been with sustainable investments in recent years, also in this more challenging time? And do you perceive that ESG factors are contributing to outperformance, and in what ways?
Yeah, thanks, Jeremy. It's interesting that I don't think we as Aviva are unique in that increasing focus. There was an interesting FT article just a few days ago that was referencing sustainability funds, the record inflows, and the oftentimes seen an outperformance. It was interesting within that they, in the context of COVID-19, had done a survey of UK investors, and they said that they thought 9 out of 10 wealth managers would believe COVID-19 would actually increase the investor interest in ESG. As interesting background. Now, in that context, in terms of our experience, if you look at the ESG funds as funds, the growth that we've seen from our experience, so we've seen that, if we take to 2015, across the sector, there were about £26 billion worth of funds in 2015. That's now grown to 65 billion in April 2020. That gives you an idea of the scale of the growth. And it's quite interesting that during the actual recent crisis, in the first 4 months of this year, actually there were net inflows still of 4.3 billion into ESG funds, net inflows, and that contrasts with 4 billion net outflows from non-ESG. So I think the market itself is speaking, and you've seen a proliferation of funds that are now launching into this space and becoming an important category for a lot of investors. Now, that's mirrored in our experiences as Aviva. I mean, we launched a European Equity Climate Transition Fund and an associated investment strategy just in July last year, and under that strategy we've now got over 1 billion euros worth of funds, and we're seeing increasing interest in that, and we expect that to expand. And so that gives you that sense of that interest in ESG. I think it's important to recognise that actually when we're tackling climate change, we have to focus on the funding to the transition, as Martin mentioned earlier. We cannot do this in isolation, but we have really an important stewardship role as investors. And it's interesting, you've seen a development in some of the ESG focus in the funds. In the first generation of funds, there perhaps was a focus primarily on mitigation, renewable energy, etc. The second generation, we saw focus on adaptation. So how can companies help support in, flood defences, etc. But what we're now seeing, and that's in common with our fund, a third generation of funds that are looking at both of these elements, but also building very much on the transition and what companies that need backing and support across all sectors that may not be perfect today, but actually are pushing hard to understand and manage their climate risks and actually move the sector and the whole economy to such funds. Now, what's interesting is that what we're observing is that companies who are strong on ESG actually have good management, they have solid supply chains. There are a lot of rationale as to why that's seeing. That's probably effective why we're seeing that in performance. I mean, we're seeing quite a lot of research from universities, even our own internal research looking at those that we're looking at on our proprietary ESG scores. We tend to see a solid performance of the top performing scoring companies. Now, in some respects, that doesn't come as a great surprise, but you'd imagine if a company is strong in ESG, then they should be managing things better and better able to adapt and transition. But I think, as Martin said earlier, another observation what we're saying is that there's an increasing importance, not just on the E, but the S and the G, and that's probably will be coming out of the COVID-19, where you have seen differentiated companies, that wider societal governance role is growing. And so we're basically seeing that well-governed companies are more likely to fare better and to perform better. So therefore, in some respects, the market is driving the money in that direction, which can only be a good thing.
Thanks very much, Hugh. Maybe Martin, just turning to you, if you had anything to comment on that, maybe thinking about a broader range of asset classes than equities. I think there's a lot of discussion now on sovereign fiscal health coming out of the pandemic. Is there any links you see coming there from a sustainability perspective, looking at Swiss Re's investments?
Yeah, so I think an important topic is infrastructure, and I think there quite a while ago, which is kind of like a merged discussion now, is really the infrastructure as an asset class. So the need to have more transparency about that. And I think now it becomes in particular important on social infrastructure, be it hospitals, be it schools, be it other infrastructure, which really serves the goal of sustainability in governments. And I see there really the opportunity for public-private partnerships on the one hand, but then also quite important investment targets. I think also what is important that from green bonds, which started quite a while ago, we have now seen also the topic of resilience bonds coming more and more up. So this is another topic. And I think really what you mentioned, it's quite tremendous how much attention is given by investors. So when we looked at the importance of sustainability strategies also on our client side, it's really a good indicator also often for the governance issues or risk management issues if companies take that really seriously. But you need to look beyond the surface a bit because obviously also a lot of interest is going in at the moment. So at the same time, you want to have a good understanding of your investment targets in that way. But I think the great thing is that investors are really interested on the one hand, but also really come with a lot of questions and detailed questions. So being part of quite a few of those investor discussions, I think this has really changed from at the beginning 2-3 years ago. I would say still major questions were perhaps on environment and diversity in the company, but now they go in very much detail. And I think that's good for the discussion so that we have a maturity in this investor discussion as well as from us as long-term investors.
Thanks very much, Martin. Now, Emanuel, turning to you, in your opening intervention, you mentioned that in certain respects, the pandemic can be seen as kind of an accelerated vision of unmitigated climate risks. And of course, there are a wide range of links emerging there. Maybe practically, in what ways can this be considered a stress test for sustainability factors in financial markets, specifically looking at transition risks? Is that a valid comparison to make? And as a regulator, what are the issues you're most concerned about in terms of climate change risks going forward in terms of potential financial stability issues? Thank you.
Yes, Jeremy. Okay. Just to comment on this image of the stress test. First of all, I think, yes, that the COVID-19 crisis was a real stress test for us, both financial institutions and supervisors in a broader sense. This pandemic made us aware of the fact that certain events can bring an entire economy to the complete stop overnight, and at least require a massive change in our organizations. So maintaining the continuity of business for both insurance undertakings and supervisors, mainly thanks to teleworking, was key to face the crisis. And actually, I would say that it was not a minor result to achieve. So I think the lessons we can draw from this experience will also be of help in order to better face similar climate-related emergencies that could appear in the future. Second, when speaking about the question on financial markets and financial stability issues, let me make some comments on the last movement we have seen on financial markets. To some extent, probably, I think that the decrease in asset prices that we are seeing right now could be considered as a preview of what could happen with certain types of assets sensitive to sustainability factors. I'm thinking in particular of the so-called stranded assets, namely those assets that are likely to lose value due to the transition to low carbon economies. In this regard, I would say that naturally that the COVID crisis does not change the importance to progressively reconsider investments in brown assets and especially fossil fuels. On the contrary, indeed, the drop in oil prices could contribute to lowering investments in this type of energy sources and increase the risk of stranded assets. So that's the reason why, from a transition as well as a prudent investment point of view, this is certainly time to reduce brown investments. Another issue I wanted to mention regarding financial stability, something naturally that we are closely looking at is the possible pro-cyclicality of downgrades of certain type of debt instruments or bonds by credit rating agencies. Indeed, whereas the effect of the downgrades on the insurers' balance sheets are already embedded via the decrease of the values, the negative impact on capital requirements could lead investors to try to get rid of these assets as soon as possible, thus reinforcing the trend, the market trend, and the decrease of values of these assets. That's the reason why recent discussions have just started at international levels to study the possible impacts of large-scale downgrades of ratings. That's the last issue I just wanted to mention. So nevertheless, the priority of mitigating the direct consequences of COVID crisis should not naturally jeopardize our work on climate and sustainability issues. And I can assure you this is not the case for all the reasons I previously mentioned. But I think this is also the case because insurer will have a key role to play in enduring climate-related risks in the very near future.
Maybe just a quick follow-up question. I think looking at ACPR's own work and that work that you mentioned, which has not slowed down, I think we were very, very pleased to see the release last week of some provisional scenarios for a future climate stress testing exercise. And I think it's our understanding this will be applied to both banks and insurers. Would you like to just offer some quick comments on that piece?
Yes, as you said, yes, we have just published the scenarios of the stress testing we will do and elaborate for the banks and insurers this year. Actually, I would say that I'm not a specialist, I mean, for the stress testing, that the objective is to conduct this exercise during the second quarter of the second half of this year. And normally we should have the results of this stress testing by the end of this year. So that's all.
Great, thanks. Well, wonderful to hear that that's moving forward. I'd just like now to notify those in the audience, we will definitely have Q&A in this session, so please do submit your questions via the Q&A chat box, and we will then turn to those later on in the panel. Maybe now, just a second set of questions for those on the panel. To you, Hugh, what do you see as the key issues or barriers in the way of a green recovery? As you mentioned, that this is really a priority and insurers have a key role to play here. I mean, what specifically do you see as some of the real challenges over the short term, recognizing that this process in terms of development and delivery of fiscal stimulus is going forward very rapidly? What are the opportunities now, and maybe what are the opportunities going forward that insurers can take advantage of, and what are the risks that could arise? Thank you.
Yeah, sure. Earlier, Jeremy, I referred to kind of like the publication we made, we call it kind of like the Marshall Plan to Save the Planet, which was basically trying to say, obviously we knew post the Second World War, there was a big investment boost, and we were trying to say what lessons can we learn and what is actually needed now. And we kind of identified 5 issues that we think are important to address and 5 potential solutions that are needed, or at least directionally we need to go in kind of like if we want to, as effect, a Marshall Plan to save the planet, which is all about how we interact between the work of the private markets and the private companies and that of the public sector and the governmental level. I mean, I think one of the first one is the fact there does need to be, this is a classic example, and we've seen that with the pandemic as well, there does need to be a global approach and a global solution into these areas. That's why for us we think the COP26 is going to be a critical development, because what we do really think we need is establish a strengthened international and national framework for sustainable finance. I think trying to do this on a global basis clearly makes sense, because if we want to act in a cohort, one of the ideas I'll come back earlier is, should we not have something equivalent to the IPCC that's in operation to try and coordinate some of these activities? I'll come back to that shortly. I think the other one is that how green projects and how public investment is directed is absolutely important. And what's very important is that particularly as we come out and go for a recovery and greater investment, is ensuring a greater share of the public sector financial flows are sustainable per se. So you're looking at that broader picture from a public sector perspective, not just from a company perspective. One of the other issues that we have, and it's an ongoing issue, is kind of the real, what part of the market dislocation is the real costs of climate and the change is not really priced in. And that's primarily because the costs just aren't reflected. We have no carbon pricing in place. So without that overlay, effectively the market distortion to a certain extent are going to continue. Now that may not be a short-term issue, but fundamentally that is kind of like one of the elephants in the room that we need to ensure that there needs to be a shift in the private sector financial flows by adjusting some of the pricing and other incentives that are referred to. Another one is just from a market to function, you need sufficient data and transparency of information. I think there's been quite a lot of work doing it. We're very active, as is Martin, in the TCFD. I mean, our personal views is that what's really important for you as an investor perspective and for the broader economy is that sustainability, risk and rewards and financial assets are a lot clearer. We need information for that. I mean, our view has been for a long time that we think TCFD approach should be mandatory, and there needs to be a lot more work done into that final space about what is your company warming potential, and we've done some work on that recently, and I think that should be something that we need in terms of transitioning planning of companies to understand as we exercise steward with investment what we do. The other one is the missing piece is the lack of customer focus, and are their customer views on products being reflected in their views? We do think we need some market education. We think we need better market educate people and a better connection between what personal finance has happened and how that money is invested. So we think that linkage is important, and if you don't address those 5 issues, you're going to have an ongoing concern. Just to come back on one idea that we've been thinking of a lot is basically trying to create an international panel on climate finance, which is, I suppose, in the finance sustainability space, trying to mirror what's happened on the Intergovernmental Panel on Climate Change, which is bringing a group of experts in that field. Actually, we think that global company, private to public dialogue is really important, and we need a mechanism to facilitate that, and we think that would help the issue as well.
Thanks very much. You have a strong call to action on many fronts, and I think we'll return to some of those points later on in this session. Maybe over to you, Emanuel. From a global perspective, clearly the IAIS has moved comparatively quickly on climate risk issues in recent years, including an issues paper on climate risks, and then earlier this year on TCFD implementation itself, bringing up this transparency priority that Hugh mentioned. How is the IAIS responding to these challenges in 2020? Maybe if you could just give an overview of the work underway, and looking forward, how can industry stakeholders contribute to this process?
Yes, indeed. The issues paper you've just mentioned on the TCFD implementation is indeed a very important achievement for the IAIS and the Sustainable Insurance Forum, the SIF, that highlights the strengths and areas of progress that the insurance sector has made in terms of disclosure of climate-related risks and factors recently. If I come to the 2020 work program for the IIS and the CIF, both institutions are very actively involved in writing right now an application paper on the supervision on climate-related risks in the insurance sector, mainly from a governance and a risk management perspective. Just to make a very short, quick reminder, you know that the aim of an application paper is not to create new additional regulatory standards. The objective is to provide additional material to supervisors, including examples and good practices or case studies, in order to help the implementation of the insurance core principles, the ICPs, developed by the IAIS. So since 2015, I think that much work has been developed by supervisors who try to understand, classify, and propose management solution to tackle these risks, mainly within the network for greening the financial system, of which the Banque de France and RCPR are very proud to be the founding member and still the coordinator. So I think there's now a growing recognition that climate change and climate-related risks are a source of financial risks that have an impact on the resilience of individual financial institutions, such as insurers, naturally, as well as on the financial stability. So now that we are able to relate climate-related risk to the existing risk categories, we saw that there was no obstacle left for the integration within the IIS framework based on the ICPs. So indeed, yes, we can make this relation between the transition risks that are close to market risk, physical risk for us can be considered as part of the natural catastrophe risk, and the liability risks are part of the legal risk. So in the paper, I just wanted to mention that in this application paper we are working on, actually, there are no specific aspects developed on the quantitative issues. These quantitative aspects are left out of the paper, but these may be covered in future work. The ICPs referred to in the paper are related to governance, risk management, supervisory review and reporting, the investment policy and strategies, and lastly, disclosure. On this last point, I just wanted to mention that whereas the TCFD issues paper you just mentioned before focused on how supervisors may encourage the implementation of these TCFD principles, which is naturally voluntary in nature, the application paper will describe good practices and example around the implementation of the ICP 20, so on the disclosure part. I don't want to be too long on this aspect, but to give you some more insight on the paper, I just wanted to say that the paper focuses on several key aspects for which it gives guidance on how to take into account the climate-related risks throughout the governance and the risk management systems. So there are a few examples of implementation from different jurisdictions, from binding rules and to good practices, so a wide range of measures. And for instance, there are developments on several key aspects, for instance, on the role of the board, the role of the control functions, on how the enterprise risk management should handle climate-related risks, so that this is a whole package. If I come to the schedule of the project, what I wanted to add is that the IIS is now finalizing the application paper, and we will submit it to public consultation very soon. I mean, probably by this summer, to involve the stakeholders in the overall elaborating process. So we will naturally welcome all comments on the proposals, in order to have a concrete paper as clear as possible, as very ready to use. And lastly, what I wanted to mention is that we would be very glad to invite you and all stakeholders and participants of this seminar to take part of the webinar we will organize with the CIF and the IIS next week on Tuesday, the 9th. So you are very welcome to join us, and I can give you the link naturally for those who want to subscribe and take part in this seminar, which will be devoted to the presentation of the paper with some more details. Well, yes, so I just wanted to stop there and stay at your disposal naturally to answer some questions. Thank you, Jeremy.
Wonderful. Thank you, Emanuel. So in the calendar for next week, another opportunity to learn more about that work advancing at the global level. I mean, maybe in parallel, I think it's important to recognize that things like the TCFD framework, while they have been in place for some time, they do require elaboration by industry to really work through what makes sense. I mean, this is a voluntary piece. There has been many calls for application in widely across the sector and within corporate sectors as well. I mean, maybe Martin, turning to you, considering your experience within the TCFD structure, do you see that there's a need for industry consensus on specific elements of the TCFD that could help strengthen consistency? And in the insurance context, what might those types of what might that consistency look like in terms of additional guidance or additional materials? I mean, what do you see is really necessary to take this from a widely recognized issue to a really mainstream behavior? Thank you.
Thank you, Jeremy. So on the TCFD, we have been, like Aviva from the very beginning, a member of the TCFD in developing the recommendations. And I think now the TCFD is in a phase where we are reviewing where further guidance is needed and where further discussion across industries and industry-specific discussion is needed. And those areas that Emanuel just mentioned, governance, I would say, is quite clear and straightforward. I think it's really important that the board has a strong role as well as the executive team in any company. Then on the strategy side, I think there the importance of scenarios definitely is a very important topic where many companies still struggle. And I think what is important, and ourselves as well, we don't have the perfect solutions there, and we are working like Aviva and others on further developing that part. So I think the insurance industry is uniquely placed with all the work on the physical risk side, with the NatCat scenarios that we do since a couple of decades to really contribute to that discussion. And I think the important part here is to combine really what are historical data, what are probabilistic modeling on that side, as well together with what are future climate scenarios if we look further down the road, both on the physical risk side, but also then thinking through on the transition risk. And let me just leave one thought here on that particular topic, that I would say we have to be really mindful where we use stress tests. I think from a Swiss Re perspective, we see the potential application when it comes to transition risk or sudden changes. So, for example, an introduction of a carbon price in a very rapid form, that's definitely a stress. But often when we talk about climate, this is moving the mean of the temperature over a certain time period. And that can't be just addressed for stress, and their scenarios are just much more important. I like in this context also the concept of vulnerabilities, which I think APRA in Australia uses at the moment. So basically to identify where in your strategy you have vulnerabilities. And that's something which at the moment in the TCFD, in particular for the non-financial sector, is addressed, and further guidance is developed as well for the financial sector in a bit shorter form. When it comes to risk management, we are currently developing further guidance on how to integrate climate risk into the standard standard enterprise risk management frameworks, which is also an area where we see that many companies have struggled so far to how to integrate that. And climate risk often can be looked at as being relevant for most other risk factors. So if we think on the insurance side, on property, casualty, or life and health, as well on the investment side. So it's like a model or a potential modulator for certain risk factors. And I think that's an important, I think, identifying what are the risks, assessing them. Many companies have started that, but how to fully integrate it on both the physical and transition risk side, that's another topic. And as you mentioned, and Emanuel as well, I think there are still a lot of open topics. So to your questions very specifically, I think at the moment there is quite a lot of discussion ongoing at the IAF, at other associations to coalesce the industry views on technical issues. And so how do we look on certain developments on the investment side? Also the Asset Owner Alliance, the UN convened Net Zero Asset Owner Alliance plays an important role. Frameworks around TCFD, but then also associations like the IAF. And I think truly that now over the next year or two, there needs to be a discussion. I don't think that uniformity is in the best interest of regulators necessarily. So you don't want to have like a crowd moving all in the same direction. So you want to have a bit different approaches, I would say, from a financial stability perspective as well. But still, there needs quite a bit of discussion what is meaningful. And I think I would support, and we have discussion in the TCFD as well, to really establish good principles which are kind of like guide marks for the industry to develop in a direction, but then leave the very details to the single companies as well. I think an important driver in here, and I talked before about clients, the second really is investors. So investors want to have the basis for decision useful information. So we as a long-term investor, we play both sides. So we are an investor and we want to have this information from corporates. At the same time, we are a preparer of TCFD information. And in that, we want to make sure that whatever topics are disclosed on climate-related risk, they are also decision useful. And in that regard, I think I highly welcome the application paper of the IES that is under development and look very much forward to interacting with the regulatory community on that. As Emanuel said, there is definitely soon a chance by the public consultation, but also very happy to follow up in more detail even between now the call next week and there.
Great, thanks very much, Martin. We do have a limited amount of time left. We have a number of questions that have come in. I think one, I think quite relevant to the question of the green recovery and also the broader kind of regulatory agenda around this is potential links to capital risk weights. And I think this is a question that I would generally target towards Emanuel, but happy for other views. What do you see as sort of the costs and benefits of either green incentivizing or brown disincentivizing factors being introduced potentially in the context of Solvency II? Thank you.
Thank you, Jerry. Thank you for this very adequate question. I mean, I will perhaps make a bit a disappointing answer on this specific issue, given the fact that it's a very difficult question, and I would say I don't have any definitive answer to that question at this stage. The reason for that is that, I mean, as you know, I mean, the solvency regime is under review now. The debate is very open between regulators on this question that you have mentioned. So the positions between the regulators are quite divided. And I would say it's probably a bit premature to have a definitive answer on this issue. The reason for that is that certainly before having a clear position on whether we should have a penalizing factor or an incentive towards the green investments and so on, is that we had to be very sure, and we should have this very strong analysis that there are some significant differences in risk, in financial risk, between brown and green assets, if I am very practical. And this is the reason why we have launched at the CPR this stress testing exercise, and at the European level and international levels also. I mean, it is not so clear at this stage whether we can clearly rely on a very clear image on the fact that there is strong differences in terms of financial risk between those two different large categories of brown or green assets. So that's not so. That's the reason why I won't give a definitive answer till now, and I will stay saying that at this stage it's still a bit premature. So we still need to go a bit further in our work on this.
Thank you, Emanuel. And I think that the recent report of the NGFS status report on green and brown assets kind of really attests to the fact that it's almost impossible to make a conclusion on this, considering that the methodologies and approaches for classification are so different across different firms, and the ingredients or the underlying components of a regulatory regime are really not in place in most jurisdictions. And I should add that I think the IIF is really interested in this question in terms of defining what sustainable investment and sustainable finance really means, and what it practically is from an operational perspective. And we definitely recognize the need to find ways to get a clear industry agreement on what can be considered a sustainable investment or a capital flow. Maybe quickly, just on this question, happy to open to Martin or Hugh for any quick final comments before we close. Thank you.
I'm happy to just take that one. I mean, I just three quick observations. I mean, one thing you do not want to do with your system is, given the fact that we are the natural long-term investors, and we're talking about long-term infrastructure investment, you do not want to provide any disincentives or adverse treatment. That would be my first observation. I know it's a challenging area. I think the second observation is, I think it would be good to basically make this debate a little bit more sophisticated. I mean, we all want a risk-based regime, but in that context, I think a very blunt black or brown or green is a bit of a blunt way of looking at this. Now, one of the issues is that if you, we need to invest in brown to encourage them to transition. So saying this is good and this is bad isn't going to help us to move the sector. So you don't want to be black and white. The one area we're internally exploring is whether you could make this a little bit more holistic in terms of, can you think about incentivizing those that are moving in a direction by looking at portfolio warming potential, so that you go away from looking at this asset is good, this asset is bad, to can you look more generically, holistically at the global warming potential of a portfolio and incentivize companies and insurers to be moving in a positive direction within a risk-based regime.
Just building on what you said, I think I agree with that. I think what is important is that we think hard how to build in externalities into how we value certain assets. And I think I just want to mention this is really a mission possible, but it needs some hard thinking. And I think it's not done by just saying, or we need to be in the risk-based regime. So we need to continue to look at that. But I think it's important that we bring in the overall view, how we can integrate those externalities in our reviews with Mission Possible. This needs engagement with clients, as you just described, but also I think, besides what you mentioned, I think carbon footprinting and carbon intensity measures will become increasingly important in a net zero world. And so many companies and governments now committing to net zero, and in advance of COP26 probably more. I think this will be a key topic to be addressed and also to thought through. So I think a good exchange between the insurance industry and the regulatory community on those topics will be important. But as you said as well, and Emanuel, I think it's not an easy ride, but ride worth taking.
Wonderful. Thank you very much, Martin. So we now close this session. Thanks very much, Martin, Hugh, and Emanuel, for your contributions. Many further topics to discuss, and clearly a great dialogue going forward within the context of the IAF's work. Thanks very much.
Thank you. I'd like to join Jeremy in thanking our panelists for a very robust discussion of the sustainability challenges and opportunities. And thank you to all of our panelists today. There are a number of takeaways from the various discussions we've had today. I'm just going to highlight a very few. The need to address protection gaps in order to respond even better next time, as Jonathan Dixon has noted. The importance of communication across stakeholders, which also emphasizes the very important human element of the challenges that we're facing. The importance of the focus on operational resilience and, in particular, cyber resilience as employees, policyholders, customers, and vendors work and conduct business remotely. The accelerated pace of digital transformation was discussed. This is a pace that is bound to continue based on consumer demand and based on consumer acceptance of new ways of doing business. And finally, COVID as accelerating the sustainability agenda and the need for a green, sustainable, and inclusive recovery, which provides both challenges and opportunities for insurers. So thank you very, very much for joining us today. Please provide your feedback on the form that we will send you, because we'd love to take your comments on board in designing our future insurance events. Thank you and good day.